Alright everybody, crazy news! This is not something I ever expected I would ever see in my entire life. Google is investing in nuclear power? Out of all the companies to do this, I was not expecting Google, but when you get to the background behind this decision, it starts to make more sense. So let's follow here. So to summarize the news here really quickly, Google has announced a partnership with a California company. It's called Kairos Power, and they're going to make small nuclear reactors, develop them for the company, and then install them as a source for their data centers and also later for AI processing power. Very interesting. It says here that it's going to be a carbon-free source of power for Google's data centers and artificial intelligence applications. And when you think about it, yeah, it makes sense. The number one reason why people sometimes criticize nuclear power for not being carbon neutral is that you have to build these massive concrete towers to help exhaust and make sure the nuclear power is safe, right? It funnels the steam out. But what people don't really realize is that nuclear power can also be much smaller scaled, and that's what these small nuclear reactors are doing. And it makes sense too, right? Because we know nuclear submarines are nuclear powered and those reactors have to be small. When you're not powering entire cities and instead using these small nuclear reactors, then these things start to make more sense. So Google's already signed this agreement. This is confirmed. It's a power purchase agreement with Kairos Power to buy the electricity generated by these small nuclear reactors. In a way, it's kind of like a carbon credit swap scheme, but not exactly. And it says here in the news that this is expected to be online and operational by 2030, so that's 6 years away, almost 5. These small nuclear reactors will be built on a small footprint, making them suitable for industrial applications like data centers. And the advantage of these nuclear reactors are that they're small, of course, and they're reliable power. Compared to wind and solar, that makes sense. Another thing too is that some can provide high temperature heat at the sites necessary for other applications, and sometimes Google does need that heat. Now, Google isn't the only company to be doing this. Amazon also, believe it or not, you may have not heard this, also is investing in small nuclear power reactors. For example, Amazon announced it's investing in small modular reactors, partnering this time though with Dominion Energy. And many of you know Dominion Energy is a major energy company on the stock market. I've actually owned that stock in the past. And so they're exploring building a small nuclear reactor near its North Anna nuclear power station in Virginia. And so while both companies are pursuing nuclear power for their data centers, Google's agreement with Kairos Power is focusing on purchasing electricity from multiple reactors, whereas Amazon's deal is focusing more on a direct investment with the reactors, right? So if you actually do want to do more of a nuclear reactor direct play, Amazon makes more sense, but at the same time too, the reason why we're even talking about this headline is because it's Google. Google is bringing an enormous amount of attention into this program. But let's listen to what Google directly has to say about this. It's very interesting.
Advanced nuclear reactors provide safe, around-the-clock power that can help Google and the world meet electricity demand with carbon-free energy every hour of every day. Our new partnership with Kairos Power will accelerate the deployment of their first commercial-scale reactor, followed by a fleet of reactors that will deliver clean, reliable power to the U.S. electricity system. By scaling technologies like advanced nuclear power and making them more affordable, we'll be one step closer to a carbon-free future.
If we look at the comments, they're actually very interesting. Very nice, it's about time. This is commenting on that people have been screaming from the hilltops for years that nuclear power is an alternative for carbon neutral attempts at generating energy, right? Alright, so now let's talk about the impact on uranium stock. So there's 3 I want to talk about here today, which is Cameco Corporation, CCJ, Uranium Energy Corp, UEC, and Energy Fuels Incorporated, UUU. I'm going to take you through all these, break them down, the pros and the cons, and so you're going to get the information you need as an investor to evaluate these uranium stocks. Before we even step into this though, I do want to say, having looked at all of this, my total conclusion is that I don't think this is really worth your time. Compared to the effort versus reward, it still makes sense to buy just a general index fund, and that's what I do with my investments, but still looking at this is interesting, and it's a good exercise practicing our investment analysis skills. So let's go through this. First thing right off the bat, let's compare all these stocks, right? So the S&P 500 has appreciated at 37% this year compared to 41% for Cameco. Now, if you count dividends in with the S&P 500, then they become more closely matched. Uranium Energy is up 46%, that's a clear winner. And then Energy Fuels UUU, that's down 17%. This is a weaker company. And then finally, Denison Mines, DNN, is up 43%. Let's talk about the financial specifics with Cameco Corporation now first. You can see their revenue growth was actually negative. They had a hard time right until the Ukraine war kicked off, and this massively turned around their revenues. Before the Ukraine war, most of the world was nervous of the fact that most of the world's uranium was produced in Kazakhstan for cheap, and so by extension, Russia could control the price of uranium. But now that those two markets have kind of separated from each other, the US markets aren't really interacting with the Russian markets, now there's more of a role for these domestic uranium producers to play. And so that's why ever since 2022, their revenues have been growing by double-digit percents. And if we go over to the margins here, their margins are all fun. Now, obviously, these aren't Apple margins. Everyone knows Apple posts anywhere from like 30 to 40% margins, but the gross margin here makes sense. When they take uranium out of the ground, that's profitable. Their profit when they operate their company, that's now up to 13%. And their profit margin is a healthy anywhere from 14 to 10% every single year. Considering return these days, I think there are a lot of investors who would be happy getting 14 to 10% every single year from their investments. But looking at the balance sheet, things get a little bit different. Their current liabilities are $481 million, as in that's their short-term debt, right? And their current assets is $1.5 billion. So what this tells me is that because they've had so many good years of profit here, what they're doing is fortifying their balance sheet, try to take care of themselves in the future, just in case they have another repeat of 2016 to 2021, where they're not bringing in much money. The shareholders' equity in this company is increasing, going from $4.9 billion in 2019 to now $6.1 billion. So that means as an investor, the value of your investment is going up. This is not the equivalent of buying a house that's underwater on its mortgage. There is some minor share dilution, especially there's very strong dilution here in 2023 at about 7%, but considering the other stocks I've shown you on this channel, up to 7%, but in reality 2% share dilution isn't bad at all, especially when this company is delivering returns for investors. If we go to the stock chart year to date, 25%, then also 400% over the past 5 years, I think investors are just fine and happy with this. And if anything, that 2 to 6% share dilution is helping the stock let off some steam so it's more approachable to investors. So out of all these, I would say CCJ is probably the strongest and most blue chip uranium company out there. Alright, so let's talk about UEC, Uranium Energy Corp. This one has trade-offs compared to CCJ. I would say it's higher risk, but also higher reward. So let's take a look here. Market cap is $3 billion. One thing you immediately notice looking at the statistics here is that their revenue absolutely cratered. They had positive revenue in 2023, and now it's nearly negative. They only made, you can see here, $0.22 million here in revenue. So what's going on here? For a lot of investors, that might actually cause panic, but I'm here to tell you there's not so much to panic here with this company. Now, it's not as great as CCJ where they consistently have growing revenue coming in, but there is revenue, I think, on the future horizon for UEC, so check this out. We have here news from Kitco. Uranium Energy trades up after announcing a $175 million purchase of Rio Tinto's uranium assets. And so for those of you who don't know, Rio Tinto is considered the mining company on the stock market. I want to say it's the biggest one, at least the biggest one that's publicly traded. That's very, very validating because Rio Tinto is a serious and legitimate company. So what I suspect here is that there's going to be a short-term drop in the revenues, but once they take over the Rio Tinto uranium assets, they'll be driving revenue similar to CCJ, assuming everything works out fine. So if that was a deal breaker before, just take this news into account. They've taken over a massive uranium asset. They're going to be extracting from that. Going back to the financials here, there is some significant share dilution here. You can see here it was ramping up to 33% in 2022, but considering that they had no uranium assets or mines operating at the time, or very little, it makes sense you'd have to dilute the stock to keep going. But now that they've secured that asset, it's only down to 9%. Not as good as CCJ, but 9% is under control compared to other tech startups and EV companies you see out there. Going over to the balance sheet, shareholders' equity is ramping up fast, so despite the revenue implosion and the repositioning into Rio Tinto's uranium mines, the shareholders are still seeing a return here at the end of the day. So dilution aside, the business strategy pivot aside, this company is still returning to its shareholders. And you can see that in the stock price. Similar to CCJ, it's up 24% on year to date. Past 5 years, it's returned almost 700, but 688% to its shareholders. And with a market cap of $3 billion, over $3 billion, size-wise, that's a big company, and you know there's a lot of inertia behind it. Now, the margins here are terrifying, but I would ignore that because, as I told you, they've just secured a new revenue source. It's not in operation yet, but if we go back here, their margins were a lot more sensible. They had a positive gross margin. They had a positive operating margin. Profit margin, that's within range to get fixed, especially considering they had a better one the year before. These margins, while not great, aren't terrible either, and I think they could easily fix these up if they get their revenue stream online. But the real reason I'm even talking about this company at all to you is because of the balance sheet. Let's head over there. Look at this. Current liabilities, $29 million. Total liabilities, $111 million. Let's go over to the assets. Current assets, $235 million. Compared to the liabilities, you can see here, that's 8 times current assets to cover current liabilities. This is a fortress balance sheet. And if we go to the total liabilities, 111, total liabilities alone, their current assets cover that by 2. So even though they're in the middle of a revenue repositioning, this balance sheet helps you worry just a little bit less. I would describe this as minuscule liabilities, just at a very quick surface glance. So UEC, still more risky than CCJ, but I will say, it's a lot more interesting. And then finally, it wouldn't be a Eugene Chargrain video without looking at a garbage stock. Now this one isn't a total trash fire compared to other ones I've seen, but as far as these uranium companies go, this one is more of a stay away than approach. And not because the company is a total disaster, it's more that they still need to prove themselves. There's a lot of good here, but it still doesn't totally shine through. This is by far the more risky and more speculative out of these three. This is not an absolute stay away, which you'll see why here in a second, but there are things to take into consideration, and there are things to keep an eye on because there are worrying things here. First of all, revenue growth, great. Revenue is absolutely ramping up. You can tell this is a market for uranium here. One thing to consider though is that it has been cooling off and slowing down since the peak here in 2022. Dilution, very low ever since the uranium price turned around, but when uranium was bad, they were diluting pretty significantly. You can see here 2019 through 2021. The margins. This gross margin is much better than the other companies I've seen. They know how to get the uranium out of the ground at the very most basic level, but the operating margins and profit margins, even when the price of uranium improved for this company, they haven't been improving their margins. So while it is getting better, you can see it's dropping from 360% here to 54%, and 478, 263 down to 27%. It's improving, but it's still nowhere near where it needs to be. Finally, liabilities. This is one thing that gives me a sigh of relief. Current assets, $208 million, right? Current liabilities is only $7 million. Not a problem at all. In total, they only have $20 million in liabilities here. Their debt is very low. I think the reason why is because they've paid for their company in the past, more so through share dilution. So while low debt is good, it does mean in this company's specific instance, more of that is being taken out of the investor's pocket versus racking up debt. So there you have it. This one, because of the bad operating situation here, they're not getting the money they need out of the ground. It's delivered negative 14% year to date, though I will say, past 5 years, it's up 200%, but you can see that's weaker than the other uranium companies. So at the end of the day, my impression, just looking purely at the numbers here, is that there's a management and operations problem going here, but there are still some good fundamentals underneath the hood. So that's up to you if you want to take a closer look and investigate this company more. It's definitely the smallest out of the three, which is another reason to be cautious about this one. Alright everybody, exciting times in the uranium markets. Things have dramatically turned around since 2022. Links down below if you want to commission a premium video. Follow me on Telegram, and of course become a member to support the channel and access premium content and premium videos. Thank you!